Good morning, students, and welcome back to the session on audit. So, in the last session, we started with the audit of insurance companies and we just took an overview about the insurance companies, the nature of this insurance business. Now, today we plan to get into the detailed discussion around the insurance companies, around the various regulatory requirements which it will have. What are the requirements related to the appointment of the auditors? What are the requirements related to the accounting of insurance companies? And then we'll also talk about the audit procedures related to all of these insurance companies. Okay, so let's get into the details around all of these insurance companies. So starting with this, we will first of all talk about the insurance companies in terms of their business and what are the types of insurance companies broadly. Because the nature of insurance business we have understood, but depending upon the business which the insurance company will have or the nature of this business can be broadly segregated into two categories for any insurance company. So let's get into that. Just 1 minute. Just open the presentation. Okay, so we can say that there are two types of insurance companies which are possible. One which is into life insurance and other one which is into insurance other than life insurance. And that will be termed as general insurance. Now, what is life insurance? Wherein the life of a person is insured. Again, very common these days, and I'm sure you must be knowing about it. And general insurance would be to insure anything other than life. We took an example of car. It could be about motorcycle, or it could be about anything which is getting insured. It could be about house. It could be about any property. Yeah. So any insurance which is other than the life gets covered under general insurance. Let us now try to understand what are the points which seem to be different in terms of these two types of insurance. Now, in relation to life insurance, first of all, this term may be fixed or variable, and the payouts are certain either as claims or maturity benefits. Now, in relation to a life insurance, the term will always be fixed and more than 1 year generally. For example, the term of this insurance policy could be for 20 years, could be for 25 years, could be for 15 years, over which the life of the person will be insured. And during this period, premiums will have to be paid. You remember the premium? Some of these terms will have to understand now. The premiums will have to be paid by the individual in relation to the insurance. And those insurance premiums will be required to be paid over this term of the policy. And once the policy is over, a certain portion, or we can say at times a fixed part, gets back to the insurer, the one who is getting insured. And in case there is any loss of life, then the claim, or you can say the maturity benefit, yeah, whatever be the case, gets paid to the individual. And it could be for multi-purposes. It could be for various purposes. It could be the one wherein it's been done for investment purposes along with life. Tax benefits are also available. Yeah. The basic purpose in this policy would be definitely to ensure But along with that, because a fixed premium will be given every year, so it may also happen that this fixed premium gets paid back to the individual after 5 years, after 10 years, after 20 years with certain return. So that's why it also becomes a kind of investment policy for an individual. There are also certain tax benefits which are attached to it. Because we pay this premium every year, so that's why certain deductions are available under income tax. So these benefits are also available in relation to such type of policy. As against this, when it comes to the general insurance, therein this benefit of having this investment or getting some returns by paying this premium year on year, which exists in case of life insurance policy, is not possible. For example, in case of life insurance policy, an individual may be paying a premium of 10,000 every year, say for next 30 years. And after 30 years, the individual will get some return. So if the individual is alive, there is no loss of life, even then some maturity amount will be paid for him. That's a kind of investment plan which is mixed up with the insurance. So over the period of 30 years, if there's any loss of life, of course the claim will be made available. But over and above that, this is a benefit available. But in case of general insurance, such type of benefits are not available. So that means whenever the premium is paid, that is only towards the insurance, only towards the risk cover. And once that is paid for a certain period, it will cover the risk. And after that, that premium is gone. Nothing will come in form of any sort of return to the individual or to the person who is paying the premium for the general insurance. For example, for car, every year we pay a premium, insurance premium, and which is generally for 1 year. Generally, we pay this for 1 year. Up to 1 year, if there is any damage, if there is any loss to the car, that gets insured. After 1 year, we don't get anything back in relation to the premium which has been paid. It's over. Correct? It's over. It's finished. Unlike what happens in case of life insurance. So we can say that this general insurance is only for insurance, whereas the life insurance not only gives us the insurance, it also provides investment and tax benefits there. Okay, clear? So these are the two striking differences between the life insurance and general insurance. But one thing we should not forget, that in case of both the insurance, the basic premise happens to be the insurance. So in case of life insurance, we are not saying that the purpose is to make the investment. The purpose definitely is to get the insurance in respect of life of the individual. All right, clear? Now moving further, we can just see some of the regulatory compliances. Considering the fact that insurance companies are also the one, which are highly regulated. Okay, so that's why they are also subject to various regulations. The regulator for the insurance companies happens to be IRDA. IRDA is Insurance Regulatory and Development Authority of India. Insurance Regulatory and Development Authority of India. And we can also look at certain aspects in relation to the regulatory environment. So let's see what are those acts, laws which will govern the requirements of insurance companies. So we can say Insurance Act is the one which is applicable to them. Insurance Regulatory and Development Authority Act. Then Insurance Regulatory and Development Authority Regulations is the other one. Companies Act, of course, because this being a company, so Companies Act is applicable. AAPE preparation of financial statements and auditors report regulations 2000. Yeah. Then there are various other regulations which are applicable to the insurance companies. Now moving further, registration of Indian insurance companies. Let's understand this requirement. What is this requirement related to registration of Indian insurance companies? Every insurer is required to obtain a certificate of registration of insurance business in India. Means for this business to be done, or if any entity or if any company wants to get into the insurance business, then it must have certificate of registration before commencing the business in India. Okay. No insurer other than Indian insurance company can commence the insurance business in India. The registration of Indian insurance companies is done in accordance with ADA regulations 2000. Okay, so that means it has to be, the business has to be started after obtaining the certificate of registration, number one. And it has to be an Indian insurance company, or we can say it has to be an Indian company who will be doing the insurance business. Okay. Now there are certain amendments. So let's understand the amendment quickly. An Indian insurance company includes a company in which aggregate holdings of equity shares by foreign investors, including portfolio investors, do not exceed 49% of the paid up equity capital of such Indian insurance company, which is Indian owned and controlled in such a manner as been prescribed. So that means if the foreign holdings have to be brought in, it is capped to 49%. Secondly, a foreign insurance company can engage in reinsurance through a branch which is established in India. And what is this reinsurance? Reinsurance means insurance of part of one insurer's risk by another insurer who accepts the risk for a mutually acceptable premium. Okay. Again, we don't need to get into too much details around the registration. It's just that in simple way, if we have to understand, it's about putting a cap on the foreign companies in terms of, or the foreign investors in terms of getting into the insurance business. Yeah. And I would also request all of you to just please keep referring to the study material, because there are certain amendments which I have been picking up from the study material only. All right. Yeah. Okay. Now, similar to what we see in case of a, bank, similar to what we see in case of a NBFC. Okay. Wherein certain requirements exist in relation to maintaining a minimum paid up capital or maintaining a minimum capital. Therein we use the term net on funds. Herein we are not using such term. Yeah. Similar requirements exist in case of insurance companies. So let's understand about those requirements now. The minimum paid up capital equity, okay, minimum paid up capital, which is equity of an Indian insurance company, should be 100 crores. and this should be considered after excluding expenses incurred in the formation and registration of companies, which are called as preliminary expenses. Generally, we know them by the name of preliminary expenses. So if there are any preliminary expenses, those should be adjusted with the capital, and then the capital should be minimum 100 crores. Okay. The insurer may enhance the same in accordance with the provisions of Companies Act, SEBI Act, and the rules or regulations whichever are applicable from time to time. Now, there is one more point which we need to understand. Insurance companies are required to maintain minimum solvency ratio of 150%. And what is the solvency ratio? What is the solvency ratio? If you have to understand, it's the excess of assets over liabilities. It's the excess of assets over liabilities. And in relation to this computation of solvency working, there's a detailed guidance. We don't need to get into too much details. Now, this solvency ratio is required to be maintained at a minimum level of 150%. This should be minimum 150%. Okay, yeah. This is the minimum requirement for companies. Now, moving further on to the requirements related to the financial statements. Let us just quickly get on to these requirements, and anyways, when we'll move further, we'll get into the detailed requirements related to all of these financial statements. Now, as around the insurance companies, of course, the preparation of the financial statements for them is mandatory, and which includes balance sheet, P&L account, a separate receipt and payment account. Now, this is over and above P&L. So, in case of insurance companies, the receipt and payment account will also be prepared. Another account is prepared, which is called as revenue account. Okay. So, that's why if you have to compare the insurance company with any other company, what do you see now? Receipt and payment account and revenue account are different, which you don't get to see in any other company. Every insurer, on or after the date of the commencement of this act or the required act in respect of insurance business, shall, at the expiration of each financial year, prepare with reference to that year the full set of financial statements. That means this is required to be prepared every year. Okay. And in relation to the financial statements, there are 3 schedules which are available, which we will also refer, and we will also form that as the basis for our discussion related to audit. First is Schedule A. Now, Schedule A is the one which contains the requirements related to form and content of the financial statements of insurance companies which are into life insurance. So, Schedule A is relevant only for life insurance companies. Schedule B, this is applicable only for general insurance companies. Schedule C, this is to the regulation lays down. So there are certain regulations of the Schedule C to the from the Schedule C, which lay down the matters to be dealt with by the auditor's report of an insurance company, This schedule is applicable to insurers carrying on general insurance business as well as life insurance business. So as around schedule A and B, we see A is applicable to life insurance companies, B is applicable to general insurance companies, but the schedule C is about the auditor's requirements. Yeah, so that's why this becomes all the more important for us. This requires the auditor to have certain considerations while auditing the financial statements of insurance companies, and for both the types, for general insurance as well as life insurance. That means every insurance company will be required to follow two schedules, A plus C or B plus, as far as its financial statements or audit is concerned. Okay. Now moving further, quickly getting on to the requirements related to audit. Now, all of these requirements that we have been discussing are all about getting an understanding of the preparation of the financial statements, or the applicability of this relevant schedule or the regulation in relation to preparation, and about the audit. Similarly, we'll also be discussing about the appointments. These are all basic understanding in relation to the insurance companies that we need to first of all cover. So moving on to that aspect, audit of accounts of an insurance company. Now these are required to be audited annually. Financial statements of the insurance company are required to be audited annually. Okay. And who is this auditor who will audit the financial statements? It has to be a chartered accountant who will be acting as the auditor. Okay, he will be the chartered accountant who will be acting as the auditor. The auditor for the audit of the financial statements of the insurance companies has the powers, has the duties, yeah, all of those which have been specified under the Companies Act. All of those remain same. Now moving on to the financial statements. The financial statements, we have understood what all these items include. Okay. Next is about the appointment of the auditors. So we understand auditor is mandatory, auditor has to be a chartered accountant. So let's see what's the appointment related requirements for an auditor. The appointment of statutory auditors. What is the statutory auditor? It means the one who will do the audit of the financial statements. Yeah, so that's the common term that we use for the auditor of the financial statements. For the auditor of the financial statements, let's understand the audit, the statutory auditor in the general insurance sector. So that means auditor of general insurance companies, its subsidiaries, its divisions would be appointed by the as well as public sector insurance companies is appointed by the CAG, Comptroller and Auditor General of India, as well as in case of other public sector undertakings. For example, if we talk about New India Insurance Company, United India Insurance Company, all of this. However, in case of others, auditor is appointed at the AGM after ensuring that auditor satisfies the compliance requirements with the relevant sections of AAPE guidelines. So that means after the regulatory requirements have been taken care of, these guidelines pose restrictions on the number of insurance companies a statutory auditor can audit. Currently, an auditor can conduct audit of only 3 insurance companies, and of which it should not be more than 2 life or 2 general. So let's see what is this requirement. So the auditor can audit only for 3 insurance companies. Audit is capped for an auditor to 3 insurance companies. And then it says, out of these 3, what's the basis that needs to be followed? Either it can be 2 life plus 1 general insurance, or it can be 1 life plus 1 general insurance. So 1 life insurance plus 1 life plus 2 general insurance. Okay. Or it can be 1 life insurance plus 1 general insurance. Or it can be, say, only 1 life insurance or 1 general insurance. Let me just move you to the board also now. Yeah. So can you see this? So it can be any of these possibilities. But as regards this option, wherein we say that these 3 audits are for 3 life insurance companies or 3 general insurance companies. Now this option is not available. So it's been capped to 2. So this option is not available. So these are the options which are available. Okay, clear on this? So only these are the options which are available. Clear? Any questions around it? Okay, so we'll move further. As around the remuneration of the auditors, this is to be fixed in accordance with the requirements of the Companies Act in the general meeting or in such manner as the company in general meeting may determine. Now moving on to the rights and duties of the branch auditors. Now what is a branch? An insurance company may have a branch. So for such a branch, if the auditors are different, so we can say one is the central division, or you can say one is the corporate part, corporate office, and there are various branches. And let's suppose for the branches, the auditor is different from the one who is auditing the corporate office, or who is auditing this insurance company as a whole other than that branch. So what are the rights and duties of those branch auditors? It's a practice in certain public insurance companies, public sector insurance companies, that the divisional office prepares a trial balance in a manner that it provides the information required to be included in various formats of the financial statements. Each trial balance in which are incorporated the figures related to the branches or the divisions is required to be audited, and report thereon is furnished to the statutory auditor. Why we are calling that to be a statutory auditor? We are saying the one who is auditing this insurance company as a whole, who has the responsibility towards the corporate part, who will consolidate at the company level, that has been called as the statutory auditor, and the auditor who will audit only the branch has been termed as branch auditor over here. the divisions of the companies carrying on general insurance business are treated for the purposes of Companies Act as their branches. It follows that the branch auditors appointed to conduct audit of the divisions have the same rights and obligations under the statute as those of the statutory auditors to whom they are expected to submit their report. So we are saying in relation to the branch which they are required to audit, the rights and duties of the branch auditor in relation to that particular branch will be no different from any other statutory auditor. The only thing is that the scope of the branch auditor will be limited to the branch. So for the purposes of the audit, branch auditor will consider branch as the company, or maybe the branch as the entity which is required to be fully audited. Yeah, which is required to be audited completely, and for which audit report will again go to the parent, or you can say audit report will then go to the head office, at which level all of these requirements get consolidated, and at which level all of these observations etc related to the branch auditor will be taken care of and get accumulated, or you can say get reported, whatever be the case, whatever be the requirement at the consolidated level. But this consolidated level is not the one for various subsidiaries or various joint ventures. It's the one for various branches. So that means company is one which has got multiple branches. Okay. So this is something which we generally understand in case of public sector insurance companies. So we can say in case of public sector insurance companies, this still continues, and there is a practice wherein the auditor at the head office level, which are called as central statutory auditor, are different from the one who are auditing the branches. Or we can say generally for the branches you will see different set of auditors. But in case of private companies, so when we use this term private company, it's not about a private limited companies. So we are saying those companies which are into insurance business and which are other than public sector insurance companies, because insurance company again has to be a public limited. So we are saying which is other than public sector insurance companies. The accounting and the operational systems are centralized, and hence the principle of divisional offices preparing the accounts and they being consolidated is not applicable. Not applicable means you will not see that in practice. For these companies which are other than public sector insurance companies, you will see that they have accounting at the centralized level. So the accounting of all of the branches is also done at the centralized level. So there's really no need to have a separate set of branch auditors. The parent auditor, or you can say the auditor of the head office, will be auditing the entity as a whole. Yeah, and this is because of the fact that all of these things are managed at the central level. Clear? Clear on this? Now moving further. Direction of Comptroller and Auditor General of India. As we understand that CAG plays a part in relation to the appointment of the auditor. So let's understand some of those requirements. CAG has the power to direct the manner in which accounts shall be audited and give such instructions in regard to any matter related to performance of functions by the auditor and to conduct supplementary or test audit of the accounts of such companies by such person or persons as may be authorized in this behalf. CAG may require information or additional information on such matters and in such form as may be directed by him in accordance with the requirements of Companies Act. Statutory auditors are required to submit a copy of their report to CAG, who then has a technical glitch over here. Yes, so I also see some network issues over here. Let me just get this fixed. Jay, 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 just give me a couple of minutes and let me just check with this the relevant team. Let me try to find out. I understand there was some technical glitch, but I'm hoping it's all sorted. Yeah. And Sumit has also confirmed it's fine now. Great. So continuing with our discussion, so I was saying that most of the things that we have understood so far were all in relation to getting an understanding about the insurance companies, getting an understanding about applicability of various requirements to insurance companies. Means what is the audit requirement, what is the accounting requirement, what are they required to do in terms of their financial statements. Okay, so these were more of general things. What are the regulatory requirements? Now we are moving more towards, or you can say towards the audit of the financial statement of the insurance company. So now our discussion will be quite focused towards the audit of the insurance companies. So let's understand those requirements one by one. First, in relation to any entity, as we have discussed so far, we have discussed it's extremely important for an auditor to understand the entity, to understand the nature of its business, to understand the environment in which the entity operates. Because only when the auditor will understand all of these requirements, auditor will be able to perform his audit procedures. Otherwise, he may not be able to structure his audit procedures properly. In relation to the requirements related to audit, in relation to the requirements related to the audit. Another very important aspect that we have discussed in our previous session also happens to be about understanding of the business. That means about understanding of the processes, about understanding of the internal environment of the entity. And these days, and also considering the fact, the nature of business which insurance companies are into, wherein the business is voluminous. Yeah, so insurance company is not the one which will have only say few customers. They will generally be voluminous. So the number of transactions which they will have will be running into lakhs. Yeah. Public is substantially interested. So that means raw data is required to be maintained. So their databases are also bulky. And all of these things for an insurance company is not possible to be maintained if they are operating on manual environment. Anyways, we can say now gone are the days of manual environment. So these days, anyway, we get to see that the companies are on IT environment significantly. And particularly for the insurance companies, it's the IT environment which is extremely important in terms of conduct of its business. Correct? Yeah, just 1 minute. Now, considering the fact that IT environment is important for the insurance companies, it becomes extremely important, therefore, for the auditor of insurance companies to understand that IT environment. A very significant role would be required to be played by the auditor of the insurance companies in terms of now not only understanding the IT environment, but also but also testing those IT applications, testing those IT controls which the insurance company will be having. Because if we look at in general, if we just try to understand in general, very simply in general terms, what are things which will be relevant for an insurance company? The database of the customer. And in relation to the customers, which are running into thousands or lakhs, their account statements, their premium, the premium which is due, which has been collected, and the premium will also be running on a month-to-month basis. It's not only which is running on an yearly basis. Their account statements when it comes to the life insurance business, which has been going on for a number of years. The claims which would have been passed in terms of any of the customers who would have any sort of loss. The claims which are in process in respect of the applications which have been filed by the customers. All of this data and all the processing of this data for insurance company happens through the IT systems. So there are a lot of reports which the auditor will also need to pull out, or the auditor will need to access and then audit, and for which it is only possible for an auditor to perform audit on those reports when he will be able to audit those IT systems, because only then he will be able to place reliance on those reports. Only when he would have tested the controls around those IT systems, he would be able to place reliance. Because then, on the basis of the testing of the IT systems, auditor would be able to understand whether the IT systems are operating effectively or not, whether there are any gaps therein or not. Correct? So considering this aspect, audit of IT environment, audit of the IT systems of an insurance company would be a very, very important part for the audit of any insurance company. Correct? Yeah. And the ERP packages on which the insurance companies operate these days are sophisticated. So that's why auditor will also need to have experts in terms of the understanding of the IT environment, in terms of understanding of the application controls, in terms of understanding of the general controls, in terms of understanding of various reports, the way those are generated from the IT systems would be extremely important. Yeah, and that's why for an auditor, having an expert or having an expertise in this area will also be very important. Okay. Yeah. Now moving further on to the requirements related to the tax audit in case of an insurance company. Tax audit in relation to insurance company. It is necessary for general insurance companies to get their accounts audited as per Income Tax Act. So that means tax audit is mandated for them. For this purpose, tax auditor may be appointed by the company itself by means of a resolution of the board of directors or by the chairman or the managing director if he is so authorized. The company is expected to fix separate remuneration for the auditor appointed for this purpose. Of course, because the tax audit is a different thing, it's a different scope, so that's why the fees or the remuneration for the tax audit will also be separate. The form of the tax audit report applicable would be Form 3CB. This is something we already know. And the prescribed particulars would have to be given in Form 3CD in accordance with the requirements of tax audit. In addition, the auditor should familiarize himself with the provisions of Section 44 of the Income Tax, because this is something we have already understood, that to perform the tax audit will not be possible without getting into the details related to the tax as per the Income Tax Act. Only when he will have thorough understanding, he will be able to perform the audit related to this. Okay. Now we'll move on to the life insurance companies and we'll understand various requirements related to audit for life insurance companies. Yeah. So we can say there are various types of products which the life insurance companies will have. Term or the protection plan, endowment or pure endowment plan, money back plan, then whole life insurance product, unit linked insurance plan, ULIP, which is very commonly known, pension or retirement plans, group insurance, annuities, various other plans exist. And most of you, I'm sure, would be knowing about some of these plans. Yeah. Very commonly, you get a call from various executives from the insurance companies who will ask you to buy a plan. Now, all of these plans are what? That is about the business which all of these insurance companies have been conducting. We don't need to get into the details around all of those plans. We need to understand the requirements related to accounting and the audit now. Now, about this audit and the accounting, remember we discussed Schedule A. Schedule A was the one which was applicable only for life insurance companies. Remember? Yeah. So we'll now understand the requirements of that Schedule A to the ADA Regulations 2002. So this schedule is what? This comes from ADA Regulations 2002, which talks about preparation of the financial statements and the auditor's report thereof. Over and above that, for the life insurance companies, please do not forget that there are certain audit requirements or auditors reporting requirements which come from Schedule C. Okay, and we'll talk about that separately. First, let's talk about the accounting principles. Now, the financial statements of an insurance company shall be in conformity with the accounting standards. To the extent insurers carrying on life insurance business, except that AS3 shall be prepared only under the direct method. AS17, that means the segment reporting disclosure, shall apply to all insurers irrespective of the requirements regarding listing and turnover mentioned therein. So all of these requirements are therefore required to be considered. Then we can see there are certain requirements related to the accounting for premium, acquisition cost, claims, actuarial valuation, for the valuation of investments. Yeah, again the investments could be of various types. Then we can see for ULIP business and the disclosures, etc. Okay, so now briefly we will cover all of these requirements one by one, and then we will move on to the audit procedures in relation to all of these requirements. Okay, because our focus has to be on the audit requirements. And most of these requirements will come from the understanding of some of these concepts. So if we talk about premium, what would be the premium? For insurance company, premium would be nothing but the income. Claims. For insurance company, what would be a claim? Claim would nothing be a cost. Actuarial valuation, I'll come to this separately. This will be a very, very important thing for an insurance company, whether it is into life or general insurance. Yeah, both. Then the insurance company will also have investments. Yeah, and for which the valuation will be important. And the value of investments will be driven by various requirements. The one which could be into real estate, the one which could be into debt securities, the one which could be into equity securities, unlisted equity instruments, all of these. Yeah, there could be various aspects to this, but all of these are the general terms around the preparation of the financial statements that you get to see, and we'll talk about all of these terms when we'll move on to the audit procedures. Moving on to the disclosures. Now, for an insurance company, disclosures are again very important. Let's understand what are the disclosure requirements. Following shall be disclosed by way of notes to the balance sheet. Contingent liabilities. Now, contingent liability is a disclosure which anyways is seen in the financial statements of any other company. So same is the case over here. Then we have got some examples of the contingent liabilities which are possible. Another disclosure, which is again very, very important, will be actuarial assumptions for valuation of liabilities for life insurance policies in force. I'll come to this point separately and in detail. If there are any encumbrances to the assets of the company in and outside India, commitments made and outstanding for loans, investments and the fixed assets, basis of amortization of debt securities. So if there are any debt securities, if there are any investments in the debt instruments, the way those are amortized, all of those requirements are given by the way of disclosure in the financial statements. Claims settled and which are remaining unpaid. Claims settled and remaining unpaid are also required to be disclosed. Value of contracts in relation to investment for purchases where deliveries are pending, sales where payments are overdue. So those are also required to be disclosed. Means a disclosure is required to be given. Operating expenses relating to insurance business. Basis of allocation of expenditure to various segments of business. Then the managerial remuneration. This is required to be captured separately in the disclosure. Historical costs of those investments which are valued on fair value basis. Basis of revaluation of investment property. So in case the insurance company is having any of these items, then these disclosures become important. Okay, these disclosures are required to be given. Now, as an auditor, it becomes important to understand all of these points because auditor needs to ensure that the financial statements are taking care of all of these points. Okay, yeah, this becomes the responsibility of the auditor. Next is about the accounting policies. Following accounting policies shall form an integral part of the financial statements. Now, this point is no different. In fact, if you read these 2 points which are given, these are something which we would have understood anyways. So even if we talk about the financial statements of a company, disclosure of accounting policies is important, and that's an integral part of the financial statements. But all of these points, you may be thinking, sir, why all of these things, which anyways we understand basically, have been highlighted here? Because we are considering this to be a separate type of entity. So we are just trying to cover all of these aspects, and we are also trying to understand that all of these aspects are equally important in the case of this type of entity also. Yeah. So that's why if any of these things which we have been discussing or which we have been discussing over here, don't get surprised or don't feel, sir, why we are really getting into too much details around it. Okay. Now, as around the accounting policies, let's understand what does it require. All significant accounting policies and the significant principles, policies, these are required to be disclosed. Any other accounting policy which is followed by the insurer, means the insurance company, shall be stated in the manner as it is required by the accounting standards. Any departure from the accounting policy should also be disclosed with the reason of departure. See, first of all, we will not see any departure from the accounting policy because that's a sort of non-compliance in a way. Yeah. So you will see that every company would be following the accounting policies in line with the requirements of the accounting standard. But at times, there are certain departures which could be because of the accounting practices. Though again, it's rare that it will happen. But if at all this has been done, if at all insurance company has not been following the accounting policies in line with the accounting standards, then such a departure is required to be disclosed. Now, as around the accounting policies, the entire set of financial statements is basically based on those accounting policies. See, without the accounting policies, or if we exclude the accounting policies from the financial statements, then the user of the financial statements would get to see a lot of items therein, would get to see the balance sheet, would get to see the premium income, would get to see the claim expenses, would get to see PPE, which would be existing in the financial statements of an insurance company. But he would not be able to understand as to what has been the basis of a recording of all of these items. Yes or no? Yeah. Whether those items have been recorded on fair value basis, whether those items have been recorded on historical cost basis, or what's been the criteria of their recognition, what's been the disclosure criteria which has been followed, nothing would be understood by the user. So that's why accounting policies always play a very, very important role. Yeah, and that's why we are considering this to be an integral part of the financial statements. Okay. Now, over and above this, some more information is required to be disclosed. So let's understand what is that information. One, investments which have been made in accordance with statutory requirement. Those should be disclosed separately. Now, investments which have been made, those would be appearing in the balance sheet. Yeah, but a disclosure for them will be made separately if the investments were made because of statutory requirement, wherein its amount, nature, security, and if there are any special rights in or outside India, those are required to be disclosed. Segregation into performing or non-performing investments for the purpose of income recognition, that would also be disclosed. Assets to the extent required to be deposited under local laws, or if there is any encumbrance which is required to be created, that is required to be disclosed. Percentage of business sector wise means into which sector, what's the proportion, means for every sector what's the proportion of this insurance company in terms of its business, that is required to be disclosed. So a separate disclosure will be there in the financial statements. A summary of financial statements for the last 5 years in the manner as may be prescribed. So this will also come. Basis of allocation of investments and income thereof between policy holders accounts and shareholders accounts. Accounting ratios. So certain accounting ratios which may be prescribed are also required to be covered therein. Okay. So this was all about certain requirements related to the disclosures, certain requirements related to the line items which would appear in the financial statements. Then there are certain instructions for the preparation. For the purposes of our discussion, we need to just keep it very, very simple, that it has to be in line with the accounting standards and also considering the ADA regulations, or you can say in line with the regulatory requirements. Correct. So now moving further, getting on to the management report, which is also required to be captured along with this. So it says there shall be attached to the financial statements a management report. Management report, the report which goes out from the management. So it's not the audit report. So it's a separate report which goes along with the financial statements and which contains some of these points, because this is authenticated by the management. Means management would have verified that. Management would have checked that yes, this report is all okay. So let's understand this report. Confirmation regarding the continued validity of the registration granted by the authority. Number 1. Certification that all dues payable to statutory authorities have been duly paid. So now all of these responsibilities were placed on the management. Yeah. So if the management is playing the role of a management, all of these responsibilities would be placed on them. But over here, by obtaining a separate report from them in writing, what has happened? So a specific declaration is coming in writing. So this responsibility has been increased. So the management has been made responsible by putting all of these points. So if they have to comment on all of these points, it will be very, very difficult if there is any non-compliance. So if you read this second point, certification. Certification means management has to confirm, management has to certify. So it's not the auditor's certificate, it's the management which needs to certify that all the dues which are payable to statutory authorities have been duly paid. Confirmation to the fact that the shareholding pattern and any transfer of shares during the year are in accordance with statutory or regulatory requirements. Declaration that the management has not directly or indirectly invested in India or outside India the funds of the holders of policy issues. Confirmation that the required solvency margins, remember the solvency ratio, 150% minimum level, they will confirm, yes, they have got the solvency margins. And why is this required? To protect the liabilities of the insurance companies, to ensure that the assets are much more in terms of the value as against the liabilities of the insurance companies. Certification to the effect that values of all the assets have been reviewed on the date of the balance sheet, and that in his belief, insurance company, that as per the insurance company, the assets which have been given in the balance sheet are shown in aggregate at amounts not exceeding their realizable value. Means the value at which assets have been recorded in the balance sheet are appropriate in terms of measurement. Means their values are not exaggerated. Certification that no part of life insurance fund has been directly or indirectly applied against the requirements of any of the regulation. Disclosure with regard to overall risk exposure. Operations in other countries, if any, with a separate statement giving the management's estimate of the risk which exists in that country, exposure towards that risk, and how the management is trying to cover that risk. So the hedging strategy. Hedging means covering the risk. So if they are operating in any other country, if there is any risk which is attached because of those operations, how the management is taking care of that risk, what's the risk mitigation plan. Aging of claims means in terms of the claims which have been in terms of the claims made by the customers, how old they have been, means what's their age, are they outstanding for a long period of time. And so the age bucketing is required to be captured over here. Certification as to how the valuation of investment has been carried out. So can you see there are so many points on which the management is required to comment on, and this is over and above management representation letter. You remember the management representation letter? Now, in terms of the management representation letter, what is it that the management issues? Management comments about each and everything which has gone into the preparation of the financial statements. Most of these points that we have been discussing in relation to the management report would be the one which would also be relevant in case of management representation letter. Correct? Yeah. Okay. Next, review of asset quality and performance of investment in terms of portfolios, separately in terms of real estate, loans and investments. Means any of the investments which the insurance company would have done, particularly for real estate, particularly for investments in any loans, the quality. Okay, so all of these investments which would have been made is required to be reviewed by the management in terms of their quality, in terms of their performance. Means if the investments have been made, are those going down in terms of the value or there is good appreciation? In terms of the returns which were expected to be generated, are those returns getting generated or are these investments running into losses, or are there any sort of losses which are attached to any of these investments? So this is something which the review should cover on the part of the management. So now this review is required to be reported there in the management's report. Next, a responsibility statement. So now within this report, management is taking the explicit responsibility. Explicit responsibility. This is towards preparation of financial statements in accordance with the applicable accounting standards, principles, policies. And if there are any material departures, proper explanations are given. Next, adopting the accounting policies and applying those accounting policies consistently. If there are any judgments, estimates, those have been made on a reasonable basis. So this is again a responsibility they will be taking. Next, management has taken proper and sufficient care for maintenance of adequate accounting records with the applicable provisions of Insurance Act, Companies Act for safeguarding the assets and for prevention and detection of frauds or other irregularities. Now from this point, we can see there are glimpses of internal control. Yes or no? And in fact, this is something which we also get to see in case of internal audit. Yeah, which is again focused towards implementation of internal controls and strengthening of the internal controls. So that's all about the risks which are attached to the organization and how those risks are taken care of in terms of having controls in place. So the management is again required to give a responsibility statement wherein they would be commenting about all of these internal controls. Because once again, if we talk about the assets of the companies as to how those are safeguarded, if we talk about prevention or detection of frauds or in relation to any other irregularities, whose responsibilities is this? This is not the responsibility of the auditor. This is the responsibility of the management. So now the management is required to explicitly cover this in the management report. Next, again, very, very important factor, and which we have discussed in the past session, that is about going concern. So the management is taking the responsibility and ensuring that the financial statements are prepared on going concern basis. And if those have been prepared on going concern basis, then that assumption was valid. Next is, of course, about internal audit system. A schedule of payments which have been made to individuals, firms, companies, organizations in which directors are interested. So that is all about specific transactions with the directors which are required to be commented upon, and a detail is required to be furnished. Okay. So this was all about the management report. Now we will be starting with the audit procedures. We will now be starting with the requirements related to statutory audit as around all of these points. Now, what's the auditors stand in relation to any of these things, or how this audit should really be conducted in relation to the insurance company? Let's get back to our discussion. We have discussed that irrespective of the nature of the business of the entity, the basic requirements of the audit will never change. Why? Because audit is all about ensuring that whatever was required to be done by the management has been done by them. Okay. Therefore, in relation to the audit, it becomes extremely important to first of all check whether the regulatory requirements, whether the policies and procedures, whether any of the organizational objectives for which any systems have been set up, whether all of these are in place, whether all of these are in line with the requirements or not. Correct? And audit for this matter, once again, has to start with an understanding. And with the understanding about the organization, about its environment, about the past experiences, audit procedures are laid out. Certain items are assessed which would be focused on by the auditor. Certain items are assessed which could be of risk to the auditor. Means there could be a significant risk which may be attached to those items. Yes or no? Now, all of these things are very important on the part of the auditor. And this is no different from the planning step. Remember the planning? Yeah. During the planning stage, auditor will be looking around all of these things. And on the basis of the planning, on the basis of the audit plan, on the basis of the strategy which the auditor will adopt, auditor will get into the execution. And this execution will cover various aspects, which will cover testing of controls, which will cover substantive testing, which will cover analytical procedures. There are a whole lot of procedures which the auditor will require to perform. And as we have discussed about audit, so the audit of life insurance companies would also be largely covering the same set of procedures, or you can say same type of procedures. It's just that depending on the nature of item which is under audit, or depending on the underlying item which is getting audited, the audit procedures will keep changing accordingly. Yeah. On the basis of the testing, on the basis of various audit procedures that are performed, conclusions will be drawn. Some of the conclusions may not be the one which are favorable to the management. So certain discussions may take place, deliberations may take place. Again, the same thing which is very commonly done in case of an audit, and because of which certain procedures may be reperformed. Certain procedures may be reperformed. And on the basis of this reperformance of the procedures, final conclusions are drawn, which are then reported upon, on the basis of which then the report is finalized by the audit, which may be a clean report or which may be having some observations. Yeah. So all of these aspects related to audit, you will be thinking, but sir, these are all general audit steps. So all of these aspects related to audit are no different for an insurance company. All of these would also be relevant for an insurance company. Clear? Yeah. So your approach of audit for an insurance company, therefore, should not really change, should remain same. Yeah. Clear? So let's move on to some of the line items of the financial statements of an insurance company into the life insurance business. And let's see what would be the audit procedures around all of those line items. First, that is about that is about actuarial process. Actuaries in life insurance business have gained tremendous importance. The role of actuary in life insurance has shifted from supervising compliances to certify whether the products and financial reports are in accordance with general regulatory guidelines. The job of actuarial department in any life insurance company involves detailed analysis of data to quantify risk. Actuarial department is calculating and modeling hub of the company. Within the department, fundamentals of insurance business is determined from pricing to policy valuation techniques. So let us first of all understand this actuarial valuation, understand the requirement of this actuarial valuation. Then I think we will be able to talk about the audit procedures. Okay. So I'll take you to the board now. Let's understand the actuarial requirements first. If you can go back to our discussion related to the business of the insurance company, we discussed that the insurance company gets claims from the customers. Okay. Gets claims means claim applications are received on the basis of which claim is required to be paid. So this is actually a cost to the insurance company, or you can say a financial loss to the insurance company. Yeah, but that's the cost. That's the cost which they have. And for doing all of these things, insurance companies charge some premium from the customers. So we can say premium is nothing but the income from the insurance companies. Yeah. Now all of these premiums which the insurance company will have, they are not limited to one, two, or few, or say few hundreds. These are running into thousands. There are multiple insurance policies which they will have. There are multiple insurance policies or plans which any insurance company will have. Correct? If you talk to any executive of the insurance company, any salesman, etc., who will call you. So for an insurance company, they will be able to tell you a whole lot of plans. Depending on your need, they can also tailor some of their plans. Some of the plans, not all. Some of the plans may be changed. Some of the plans may have premium structured on a monthly basis. Some plans may have premium structured on an annual basis. Some of the plans may require premium to be paid every year till the end of the policy. Some of the plans may require premium to be paid only once, or say for a few years, and after that, insurance policy will continue with the existing amount of premium which has been paid. Yeah. So there are so many ways, there are so many plans that we get to see. Just give me 1 minute. Now, as regards these premiums which the insurance companies receive, we understood that the amount of premium is not a significant amount. So let's suppose this is only 10,000 rupees, for example. But after getting an income or a charge of 10,000, at times insurance company may be required to pay a significant amount to a customer. So a customer, so let's suppose there are various customers, C1, C2, C3, C4, C5, C6, C7, C8. So a customer who may be paying only rupees 10,000, yeah, may claim 10 lakhs because of the loss which the customer may have. Correct? So now can you see the proportion with which insurance company may be impacted by? It's a significant amount. It's a significant thing on the part of the insurance company with which they will be impacted. Yes or no? Yeah. Now considering this aspect, we also thought in the last session, if you remember, we also thought about it, that what's the benefit to the insurance company? How are they really able to generate the profits? Because ultimately it's a company for a commercial purpose. They are not here for charity. They also want to make money. So how will they make money? If after getting 10,000, if they are paying 10 lakhs, how will they be able to survive? How will they be able to generate the profits? There we understood one aspect, that premium is charged from each and every customer. So there may be thousands of customers who are paying the premium, but claim is not paid to each and every customer. Why? Because each and every customer will not be able to get into a situation, or we can say it will never happen that there is a loss of life in respect of each and every customer before this policy ends. Yeah. So it will never happen that for each and every policy, insurance company will be required to pay a claim amount because of loss of life. Because otherwise, what will happen? They will have to shut their business. Now, this possibility of loss of life, because of which the claim may have to be paid by the insurance company, is first of all assessed by them. They make this assessment that what's the probability. So they will have to get into an assessment. They will have to assess the probability of getting a claim. Okay, probability that a claim will be made by how many customers out of the bunch of customers which the insurance company will have. And why is this probability important? Because on the basis of this probability factor, on the basis of this assessment, they will be able to know that what's the amount of liability which they need to maintain, or what's the amount which they may have to pay to the customers during the term of the policy. And this policy may be continuing, let's suppose, for 20 years. Let's suppose insurance company makes an assessment that out of the total customers, it has got 10% customers. Okay, 1 out of 10 means 10% customers will be claiming this, because there's a possibility, there's a probability that 10% will be losing their life during the policy period. And once again, it's not something certain. There are a whole lot of factors again behind this. Let's understand what are those factors. First will be the age. Age, that will be the factor. If you all know, when you get into any insurance policy or when you discuss any of the insurance plan, so the executive will always ask you first thing, that is about your age. Depending on the age, he will understand what's the risk. Higher the age, higher will be the risk of loss of life. Yeah. So this probability increases. Second will be the health condition. Correct? Health condition. Third will be any past diseases, etc. Yeah. Similarly, there are various factors which are considered by the insurance company for making this assessment. Now, let's suppose on the basis of this assessment, insurance company fixed a premium of rupees 10,000 and assumed that after getting this premium of 10,000, they will be able to make money even if claims are paid to 10% customers. Okay. And now let's suppose this assessment of 10% goes wrong. Actually, the claims were required to be paid to 30% customers. Though I'm making it 10 to 30, but you'll never see such a significant change in terms of their assessment. Otherwise, it will be very, very difficult for such companies to survive. Huh? So I'm saying practically you will not see such a significant change. This is only for our illustration that we are doing this. Now let's understand the consequences if this changes from 10 to 30%. Now in this case, what will happen? The premium amount which the insurance company would have received may become very significantly, significantly lower as compared to the amount of claim which is paid or required to be paid. Yeah. So what will happen? Because of this business of the insurance company, the financials of the insurance company will be significantly impacted. Yes or no? This would have a significant impact on this insurance business. And that's where the need for an actuary arises. So that's why insurance company needs to have a very strong mechanism, very strong basis for assessment of this amount, or you can say for this entire process, for this entire assessment to be done, there has to be a very strong mechanism with the insurance company, because that becomes the basis of their business. That may challenge the very basis of their existence in the future if this assessment goes wrong. Correct? And that is where it's valuation. So what's the valuation now? Valuation of this premium, valuation of this overall policy. What are the probability? What are those chances? What is that assessment? This has to be done by an expert or by those persons who will have expertise in this area, and those happen to be the actuaries. So you can say it's a specialized area which is focused towards determination of some of these things. Okay. Now, for an insurance company, again, considering the size they are into, it's generally not possible that they will have an actuary who's actually an outsider, means who is a consultant to the organization and who is involved on all of these activities. No. Generally, you'll see a set of actuaries who are employed by the insurance companies, because for them it's a regular activity and for them it's a very critical activity. Yeah, it's actually a process. Now we have understood what's the process. and who is the expert who is involved in this process, and what's the need for having that expert for such process, because it's very, very critical for the insurance company. Clear? Yeah. Now let's try to understand what would be the role of an auditor. I'm just hoping that with this understanding you would have already understood the importance and to a certain extent the role of the auditor, but still we can just get some more aspects around it. So what's the job of the actuary? The job of the actuary or the department. So there's a separate department in case of insurance company. You'll see of all of these actuaries who are involved in detailed analysis of data to quantify the risk. Yeah. Now understood? Actuarial department is calculating and modeling hub, because with them this plan comes into place. With their assessment, with their working, with their analysis, with their valuation, this plan comes into existence. Within the department, fundamentals of insurance business is determined from pricing to policy. Yeah. So what's the role of the auditor? Auditor in the auditor's report would be required to certify. So he is required to certify whether the actuarial valuation of the liabilities is duly certified by the appointed actuary, including to the fact that assumptions for such valuation are in accordance with guidelines and norms, if any, issued by the authority and or the Actuarial Society of India in concurrence with the Insurance Regulatory and Development Authority, IRDA. Yeah. Hence, we see that the auditors generally rely on the certificate issued by the appointed actuary, who would certify the policy liabilities. However, the auditor may discuss with actuaries with respect to the process followed and assumptions made by him before certifying the policy liabilities. And some of the things which the actuarial department broadly concentrates on are product development, pricing of the product, experience analysis, model development, valuations, your business planning, solvency management, all of these things related to the product. Now, we are not really done with the audit procedures on this actuarial process, but I think we should now take a break. After the break, we will continue with our discussion and we'll continue on the audit procedures onto this actuarial process only, and then we'll move further. Okay, yeah. So let's take a break of 10 minutes. And after this, we will continue. In the meantime, if you have any queries, please send those and we'll have a discussion on that. Fine. So we'll continue with this. So I have this query coming from T. Jagatish. He's asking, each and every premium risk coverage is separately collected, then why there's an actuarial? See, when we say each and every premium risk coverage is separately collected, I think you are talking about the premium. So you're saying each and every premium is separately collected. There's no doubt it's separately collected. But we are saying in terms of determination, the basis of this determination of the amount of premium is done by whom? And this basis is sort of assessed by who assesses as to what will be the amount of this premium. Even though it's collected separately, who is it that will help the management to get into this assessment? It's the actuary. Okay, so it's the valuation. It's not about the collection. It's the valuation that we have been talking about. So it's the pricing of the product that we have been talking about. So for an insurance company, what's the product? Policy is nothing but a product. So we are talking about the pricing of this product so that this product is able to generate margins for the company. Okay, now clear on this? T. Jagadish, you are now clear on this? Now moving on to the procedures around actuarial process. For the actuarial process, one thing which we discussed was about obtaining the certificate and placing a reliance on that certificate. But if you go back to our discussions, wherein we talked about actuarial valuation of gratuity, remember we discussed that with the help of an example. And if you also remember, we discussed about involvement of an expert from the auditor side. And we also discussed about involvement of an expert by the management. Yeah, there are separate auditing standards on this. In those auditing standards, we discussed that even if an expert is involved by the management, which would be in-house, so this actually could be in-house, and definitely this will be in-house over here because there will be a complete team of actuaries who will be working on this entire process, or that expert is external to the organization. So that means that's not in-house, that's an external expert. In both the cases, the responsibility for the preparation of the financial statements would continue to lie with the auditor. So with the involvement of an expert or this valuation expert, which is actually no way the responsibility of the financial statements in terms of their audit or expressing an opinion on those financial statements is cut down to any level. So it's not happening at all. So that responsibility still remains for the opinion on the financial statements. And this entire responsibility is on whom? Auditor. And that's why when it comes to this such a significant process of the insurance company, audit procedures are required to be performed, which will go beyond merely obtaining a certificate. Because if the auditor simply obtains a certificate from the valuation, then will that be an audit procedure? No, that will be nothing. So what is it that the auditor needs to check? So auditor needs to audit this complete process. Auditor needs to understand this complete process. This process would have also involved certain controls. There must be certain risks which are attached to this process also. The auditor needs to get into a detailed understanding around it. And then the management controls. around this process would have to be tested by him. A very, very simple procedure which the auditor should do will be to check whether the actuary who is doing this job is really competent to do that or not. And this assessment would have been done by the management. So auditor only needs to check the assessment of the management. During the valuation, there are various assumptions which are used by the valuer, and actuary is no less than a valuer. Actuary is actually a valuer. Yeah. So he must have used various assumptions. Yeah. So all of these factors, if you'll see over here, the mortality rate, the age factor, yeah, there are so many things which are attached to the data which the actuary would use for the customers. All of those assumptions are required to be audited by the auditor. Because only when he performs the audit, only when he challenges all of these assumptions, he would be able to ensure that there is no material misstatement which would have taken place. Having said that, we are not expecting the auditor to become an expert in this area. We are not expecting that only an auditor who is expert in this area will be able to audit. No. As we have understood in the past sessions, that auditor is the one who will have expertise on the financial reporting areas, and that will be primarily focused on accounting or auditing. For some of these areas which are required to be audited by the auditor, auditor would also consider involving experts from his side. And because this is such a significant activity, that's where the involvement of an expert from the auditor's side, because he doesn't have this expertise, increases considerably. Yeah, and therein we need to remember the requirements of both these auditing standards: involvement of an expert of the management and involvement of an expert of the auditor. Yeah, so both these auditing standards would actually play a significant role in such type of business scenario. Okay, clear on this? Clear on this part? Moving further on to another area which the auditor would need to check. Reinsurance. So let's understand about this, and then we'll also understand what would be the audit procedures around this. So what is reinsurance? It means one insurer is purchasing coverage from second insurance company in respect of the risk which first insurer is insuring. So let's suppose there's a customer who went to an insurance company for coverage of risk. So the insurance company has entered into a contract. So there's a policy which has gone out from insurance company to the customer. And this insurance company has moved on to second insurance company for coverage of this risk. Okay, this is called as reinsurance. So we can say it's a risk mitigating tool. So what is this? We can say it's a risk mitigating tool which is adopted by the insurer, whereby the risk underwritten by one insurance company is transferred partially to another insurance company. Because insurance company would also have assumed some risk. It would not have transferred entire risk. Otherwise, what's the business of this first insurance company? Now, in relation to this, let's understand what is it that the auditor will do in terms of his audit procedures. One, this entire understanding would be documented in the form of a policy, in the form of an agreement, policy with the customer and the insurance company, number one, and contract or the agreement which the insurance company will have with the second insurance company, or you can say agreements with the reinsurer. So these agreements will have to be studied, will have to be analyzed by the auditor. Updating or renewal of agreements and verifying whether the insurer has adhered to the terms and conditions of the agreement or not. Verification of the payments. Now in this case, two payments would be made. One, by the customer to the insurance company, and second, by the insurance company to the second insurance company. Correct? Yeah. So both of these would be tested by the auditor. And again, this testing or this analysis or this checking of data or checking of the underlying documents will not be done on a 100% basis. No, it will not be done on a 100% basis. This will be done on a test check basis. So first of all, this entire data will have to be obtained in respect of the reinsurances that the insurance company will have. And amongst that data, some of the samples would be selected and which would then be tested by the auditor with the help of these supporting documents. Okay. Moving on to the next item, that is about policy lapse or revival. So let's understand what is this policy lapse. Very commonly you would have understood that if we don't pay the premium, policy would get lapsed, and which is then required to be revived. So let's understand this. What is lapse? It's the discontinuance of the policy owing to non-payment of the premium which is due. The term lapse is not defined in the insurance regulation except stating that a policy which has acquired a surrender value should be kept alive to the extent of the paid up sum assured. Okay, in very simple terms, for our purposes, we'll just keep it very, very simple. Yeah, we'll keep it very, very simple. That the customer should keep paying insurance premium on time as per the terms of the policy. If that is not paid on time, up to a certain period, a delay is acceptable. Okay, with which some penalty may have to be paid. But after that, policy will get lapsed. And when the policy gets lapsed, then its revival will be required to be done, which will again be possible with the payment of premium, but a heavy penalty will have to be paid. So now in this case, what's the role of the auditor? The primary objective of the auditor is to check and confirm that the due dates are recorded and monitored properly, and the policies are marked as lapsed on non-receipt of renewal premium within the due dates of the grace period. In case of revival request, whether adequate checks are in place for receipt of outstanding amounts and adequate documents are obtained before reviving the policy. See, every insurance company would like to show their policies are active. So we can say lapse policy means the policies which are not active now. Okay, because actually on that premium has stopped coming. So it's again one of the controls which the insurance company should have to check whether the policy is lapsed or not, and what are the due dates to track that the premiums are received on time. And how can the auditor check it? Auditor will have to check the system of the organization. Auditor will have to check as to how the organization is tracking. So there must be a system which the insurance company would be having to track the due dates in respect of various insurance policies. These due dates are something which are falling due every day, because there will be so many customers. So it's not that every insurance company will have only one due date in a month. No, every month, every day will be a due date to any customer, or we can say to any of the customers. Yeah. So a very strong mechanism has to be put in place by the insurance company in respect of these items. And the auditor needs to audit that system. Only then he will be able to place reliance on the numbers which are flowing into the financial statements in respect of any of these policies. And in case the policies have got lapsed, requests would have been received by the insurance company for their revival. If the request would have been received, then on the request, certain documents are required to be produced. Penalties and outstanding amounts are required to be recovered first of all before making that policy reactive, okay, or before reviving that policy. Now, as an auditor, all those supporting documents are required to be checked. It needs to be checked whether the policy was lapsed and what's the amount which was outstanding therein. And when the policy got revived, whether that outstanding amount was recovered from the customer or not, with of course, if any of the penalty which was imposed. Now, this once again is not easy for the auditor to track. If you can see about the actuarial process, if you can see about the reinsurance, if you can see about this premium collection, if you'll see this process of the policy getting lapsed and the process through which the policy will be revived. Most of these activities in an insurance company would be automated. Means you'll not see these things with significant manual intervention. No. There will be systems, there will be IT systems that the insurance companies will be working on. And that's where we discussed that in case of audit of insurance company, audit of IT environment would be a very important part. Okay, clear on this? Moving further on to the policy surrender. So let's understand what do we mean by policy surrender. Surrender of an insurance policy refers to voluntary termination of the policy. Means the insurance contract has got terminated before the term of the contract. So let's suppose the policy was to end after 20 years. Starting from today, the policy was to end after 20 years. Over a period of 20 years, premium was required to be paid by the customer. Say after 10 years, customer decides that he doesn't want to continue with this policy. So after a certain period, there's an option available to the customer in most of the policies that he may surrender his policy. Okay, when he is surrendering the policy is coming to an end. And there again, you see the time periods. Let's understand this. Let's understand this. So for example, this is the period, 20 years. And that is where the policy starts. So if the policy is continued till the term which is specified in the policy, this is called as maturity, or you can say maturity date. Maturity date is the date when the policy gets matured, comes to an end as per the terms. Another thing is that any date before this policy is surrendered. Okay. Policy is surrendered. And who will do this? Customer. That means the policy holder. Because he doesn't want to continue with this policy, for which there could be various reasons. Maybe he has got some better policy with any other insurance company. Maybe he doesn't have the premium amount anymore to pay for this insurance policy. Because of various factors, this may be done. Now, at times, there is a minimum period which is kept by the insurance company. Let's suppose this is the minimum. At times, there is a minimum period which is kept by the insurance company, on the basis of which, or after which, on the basis of which even if the policy is surrendered, means if the policy is surrendered during this period, then no amount is paid to the customer. Okay, so over this period, or during this period, or up to this period, if the policy will be surrendered, then the amount will not be paid to the customer. But after this, if the policy is surrendered, then it may not be the 100% of the amount which would become payable to the customer, but still some portion would be paid. Maybe 20% of the sum assured or 30% of the sum assured. Generally, we see these types of arrangements. Okay, generally we see these type of arrangements in the insurance policies. Okay. Now, as regards these policy surrenders, etc., let's try to understand what are the audit procedures, what are the considerations which the auditor need to have. Okay. Yeah, let's try to understand some of the procedures around it. Surrender of an insurance policy is the voluntary termination. The process of surrender is initiated by the policyholder. A policy becomes eligible for surrender on completion of 3 years. Generally, as I told you, generally there is a period. Okay. The policyholder has to submit the surrender request form duly signed off by him at the branch or the processing center, along with certain documents. Okay. Now, as an auditor, considering all of these activities, steps that we have discussed, what is it that he will do? He will ensure whether all of these steps were there or not. Means if all of these steps would have taken place, the customer approached the company, he would have submitted certain documents, and if this is really a case of surrender, then whether there are documents for the surrender or not. If the surrender has taken within this time period, then nothing should have been paid. And if the surrender is taken after this time period, then something less than the 100% of the sum assured would have been paid. So all of these things would then be verified by the auditor with the help of these these documents and will also be understood by the auditor on the basis of the terms and conditions of the relevant policies. Okay. Next is about premium accounting. Now, premium happens to be the most significant component, most important component in the financial statements of the insurance company. Why? Because premium is what? Premium is the revenue of the insurance company. Premium is the revenue of the insurance company. Correct? Now, for this premium, there could be various types which one may have to consider. First, it could be related to a new policy. It could be related to an existing policy which is getting renewed. Okay. Now, for all of these types of premiums, they will all be getting generated on the basis of the terms and conditions of the policy. They would all be getting generated as per the terms and conditions of the policy. So there are certain points which we need to understand specifically while recognizing the premium. And all of these points would therefore become important on the part of the auditor. First, when the new policy is issued by the company, insurance company, new business premium, that means new premium is recognized on realization of premium. So it's not on accrual basis, on realization of premium. So when it is received, generally policy is underwritten only after receipt of first premium. However, in certain cases, policies are issued awaiting realization of premiums. For example, policies are issued subject to realization of checks. Underwritten means policy document is issued to the customer. Auditors are required to check these cases and ensure that the accounting is in line with these requirements. Renewal means premium on renew of a policy is recognized on, once again, realization of the premium amount. So on the due date, when the premium has become due because the policy should get renewed, the premium income cannot be recognized if that is not actually received. So it's on receipt basis. Okay. Or when the premium is due but not received up to the end of the grace period. Yeah. Next, auditors should also evaluate various sub-processes employed by the insurance companies in accounting of premiums, like collection of premium from policyholders, booking of premium, banking, accounting, reconciliation of the same. Now, for premium, there are a whole lot of steps which can be performed. Actuarial process, which we discussed, was nothing but the calculation of premium. And that actuarial process, once again, will not be working manually. The organization, the insurance company would have some systems. There would be certain programs which they would have designed to compute the premiums, depending on the age factor. So within a particular policy, depending on the customer, the age bucket into which he exists, the location to which he belongs to, the health conditions that he will be subject to, the family details that will all have a bearing on the insurance premium. Correct? So as an auditor, what needs to be checked? Check the premium computation. Check the way that premium has been computed, its calculation, its modeling, and its valuation with the help of the policies and procedures of the company. And why I'm saying policies and procedures? Because those will be in line with the ADA regulations, those will be in line with the valuation principles. Then to check whether the premium is getting collected or not on time. And if that is not getting collected on time, whether that is not getting recognized in the books. And if that is getting recognized in the book, that's an error. Correct? So there has to be proper reconciliation in terms of how many premiums would have become due, out of which how many would have been received, and how many would have been recognized in the financial statements. So there should be a complete correlation. There should be a complete reconciliation as around all of these items. And this happens to be, as I've told you, the most important part of the financial statements, because this is nothing but the revenue of the insurance company. Accounting of advance premium. Many a times, premium may also have been received in advance. Now, as an auditor, he would need to verify what's the mechanism of the entity of the insurance company to track these premiums which are received in advance. What's the identification of the premiums which are received in advance, and how do they differentiate these premiums which are received in advance as compared to the premiums which are received on time? Because the way those are required to be recorded have to be different, because till the time those have not really become due, they cannot be recognized as income. They have to be kept as a liability, right? So this accounting aspect around the amount of premium received in advance will again have to be understood by the auditor and verified. And most of these informations are generated from the IT systems of the company, and which are therefore required to be verified by the auditor. Checking the methodology for generation of MIS. MIS means the internal reporting systems of the management, and to ensure there is no manual intervention. Because if the process of the organization requires no manual intervention, if that would have taken place, then the auditor needs to get into the reasons as to why that manual intervention would have taken place. What's the reason for that? Okay, were there any adjustments which are required to be covered there? Check the maker checker before finalizing the MIS. Check the reconciliation in terms of the premium income which is shown on the software, or maybe the package or the systems, IT systems which the insurance company may be maintaining, and the amount of insurance company which is flowing to the books of accounts or the financial statements. If there are any differences between these two, what are those reasons because of which there are differences? Check whether there are appropriate standard operating procedures in relation to the premium. So this is all about policies and procedures, and there should be a proper DOA, delegation of authority metrics, in place for authorizing some of the things related to the premium. For example, if a customer has got some discount in terms of the premium, who has approved this? If the customer defaulted on the payment of premium but still no penalty has been charged, who has approved this? If the premium has not been paid because of which the policy should have been lapsed, but still that's been approved and the policy has not been lapsed, who has approved this? Yeah, so there has to be a complete authority matrix which will control the system. Okay, so this is again about checking the system on the basis of which all of these workings will flow. Yeah, all of these steps therefore would have to be performed by the auditor. Clear? Now moving on to next very important item, that is about claims. Now, as around the insurance company, we all understand that two things are important for them. One is the premium, and second, of course, is the claim. Because premium for them will be the income, and claims for them would be the costs which are attached to those business. So claims in an insurance business are again very important area for the consideration of the auditor. Now, in terms of the claims, the factors would be no different from what we would have discussed in case of premium. But with the claim, there comes another process, and that is about the process of making a claim by the customer till the time that payment against the claim is made by the insurance company. So we can say for this claim, first of all, let's suppose there is a customer he would reach out to the insurance company for a claim. He would reach out to the insurance company for a claim, and then the insurance company would either make the payment or not to that customer. Correct? Yeah. I have included bank over here because the payment will be made to the bank. So it may be made or it may not be made. So this once again is a process of this business which needs to be understood. So this process of claim or processing of claim or the payment of claim needs to be understood by the auditor. Auditor needs to have a thorough understanding around it. Yeah. In relation to this claim process, there are few things which the auditor needs to check. There must be certain terms and conditions basis which a customer would be able to place a claim on the insurance company. Correct? So now first thing will be the application which has gone out to the insurance company. Then the insurance company will verify all those factors basis which claim could have been accepted. All those factors basis which claim would have been accepted and then paid by the insurance company, and all those factors which should not be considered by the insurance company for making the payment of the claim, and basis which a claim may be rejected. Yeah. So all those factors will have to be analyzed by the insurance company, on the basis of which they may either pay or not pay. Now, what is the audit procedure around this? What is it that the auditor will do in respect of these claims, etc.? Let's understand. These are the areas. You can just quickly flip through them. These are the areas around the claim process. And now let's look at the audit procedures. Auditor should review the standard policy document to ensure the policy document prescribes the minimum documentary evidence to support claim. So the documents which have gone out, so whether those documents were in place or not. Auditor would have to verify the details of all the claims which have been made, and with an aging bucket. There could be claims which are quite old, and there could be claims which are still in process and which are not very old. There could be certain claims which have been rejected, for which the auditor will have to understand as to what were the reasons. The auditor's job is not really limited to only those claims. Auditor's job is not only limited to only those claims which would have been paid or which are in process. Even the claims which would have been rejected needs to be analyzed by the auditor, because there could be genuine reasons of making those claims and which may have been rejected by the insurance company and which may fall as a liability on the insurance company in future. Yeah. So we cannot assume that only the claims which are in process or which are getting paid will be considered. Even the claims which are getting rejected will be important. Understood? All of these claims should have a proper database, should have a proper tracking mechanism. So if there is no tracking mechanism, then the very existence of this business will be challenged, because that's once again the basis. Correct? It should be ensured that there is a system of collecting appropriate KYC documents as required. And if there are any discrepancies, those are intimated. So if the customer has raised a claim and there are certain documents he needs to provide on the basis of which payment can be made, and let's suppose if those documents have not been provided by the customer, then a communication needs to be sent back to him. So once again, it's a process which follows between the insurance company and the customer. So whether that's been going on or not, whether the insurance company has reached out to the customer requesting for the additional documents or not. Okay, so all of those aspects are required to be verified by the auditor. It should be ensured that all the processed claims are accounted for. Yeah. It should not happen that there are certain claims which have been processed but for which accounting. So that means the system which the entity would be maintaining in terms of the claims, that should be reconciled with the accounted for claims or the claims which have moved into the books of accounts. So there should be a proper reconciliation between these two. And if there are any differences, there should be good reasons for that. It should be ensured that adequate provisioning has been carried out in cases of all the claims which are intimated but not yet paid. Now, accounting over here will not really work on cash basis. For the claims, we cannot say that the claims should not be provided, should not be accounted for in the books till the time they are not paid. If they are legitimate claims for which payment has to be made by the insurance company, then a liability corresponding to that claim should be recorded. This liability may or may not be paid immediately. There could be some time gap or there could be some reasons behind it, but the liability has to be recorded. It should be ensured that the claims cost includes claim settlement cost, if any. And in most of the cases, insurance companies would be incurring such type of costs. Yeah. In case of living, survival, maturity, annuity benefits, it should be ensured that the liability is automatically triggered. It should be ensured that there is a system of regular reconciliation between the books of accounts and the claims management system. And the liability should also be booked net of reinsurance. Whenever there is a reinsurance, what will happen? The moment there is a liability of or on the insurance company, it will be passed on to the second insurance company, from whom it was reinsured. So the claim liability would therefore be netted off with the claim that the first insurance company would receive from the second insurance company. So once again, if you'll see, it's all about getting into the details of the system. It's all about audit of a process. Correct? Yeah. Because the functioning is such, the mechanism is such that if the process is not audited in totality, then there's no point checking few documents. That will not really serve the purpose of audit in such cases. Okay, clear? Moving further on to the next item, that is about investments of the life insurance policies. Investments in respect of this portfolio of life insurance companies. This comprises of shareholders funds and the policyholders funds. Now, policyholders funds can be further segregated as linked and non-linked. An insurer essentially manages the funds for policyholders. Therefore it becomes imperative for the insurer to have adequate systems and processes that should not only ensure robust internal controls, financial transparency and equity, but also bring effective governance so as to serve the interests of the management, stakeholders, consumers, society. Now, as around some of these investments which are made, what's the responsibility? See, some of these investments are made towards the policyholders. In fact, some of the part which is going towards the investment in respect of those policies which have some investment component. So it's the money of whom? It's the money of customers, which the insurance company is required to invest somewhere. Okay, which the insurance company is required to invest somewhere. So if I have to change this diagram, so it will appear something like this. Okay, then they will be making the investments. Correct? Yeah. Now, as around this process, as around this requirement, so what's the thing which we need to understand? Auditor, during his review of investment department, we are calling this as investment department because most of the investments would be managed by the insurance company. They would be managing this because they have this function, they have this activity, they have this business of making the investment towards these policies. Yeah, so that's why it's a separate department of the insurance company which would be taking care of this aspect. Review the investment management structure to ensure adequate segregation of duties. Review of insurers' standard operating procedures means what are the policies and procedures in relation to all of these investment decisions which are taken by the insurance company and whether those are in line with the regulations of IDA or not. Review of their policy and ensuring whether the policy is in line with the regulatory requirements. Review of functioning and scope and minutes of investment committee means how do they really function, what's their structure, and in their minutes some of the aspects would be discussed which would form the basis of this insurance company making the investment. Yeah, so all of these things are important for the consideration of the auditor, for them to know as to what has become the basis of the insurance company making such investments. Compliance of all the regulations which are relevant. Then there are a whole lot of procedures which the auditor should do. Ensure that the system is able to automatically monitor various regulatory limits, if there are any, in relation to exposure and rating of debt instruments. Review of fund-wise reconciliation with investment accounts, bank and custodian records. Ensure that there is split between shareholders and policyholders funds. Earmarking of securities between various funds. Okay. Now, most of these requirements that we have been reading, they are all regulatory requirements in relation to the investment decisions, in relation to the function of this investment by the insurance company. Review and check insurers' investment accounting, its valuation policy, and the controls around this process. Again, very important area, because this will be the basis for the auditor to actually track it over and above the systems which the management may be maintaining. Controls over various system interfaces, such as seamless integration of data between front office and back office in the investments accounting system. So what has really been going into the investment system and how that is really getting accounted for. Yeah. So that integration, whether that is in place or not, and how that would have been taking place. So all of these aspects would have to be analyzed by the auditor. Yeah. Controls around personal dealings, insider trading, front running. So when the auditor would be auditing all of these areas, the focus of the auditor would always be on the controls which the management will have. And of course, a very significant part in relation to investments would be about the delegation. delegation of authority. So this DOA matrix would be very important for the auditor to understand. Okay. Now moving on to the next area, that is about operating expenses related to the insurance business. And in terms of the operating expenses, we can have whole lot of expenses related to the insurance business. It could be about legal and professional charges, commission which is payable to agent. Yeah, so there can be so many expenses which are relevant over here. Employee remuneration, welfare. Now coming to these type of expenses, as around the audit procedures, I don't really see a big difference between what any company other than insurance company will have in place. Okay. Both the types of companies will have all of these aspects quite similar. And in relation to most of these expenses, the audit procedures would not really be limited to the control testing. This would also extend to the substantive testing. And in the course of his discussions, in the course of his procedures towards the substantive testing, focus of the auditor will also be significantly on the analytical procedures. If we talk about employee remuneration, so what would be the procedures around it? The procedures would be to obtain the database of the employees, to check whether all the employees have been captured in terms of the salaries or their remuneration, to check whether all of their components of the compensation have been covered while computing their compensation, and which would have got recorded in the financial statements. Yeah. Now, in relation to this, when the auditor would be performing the procedures, so over and above control testing, you would also be doing the substantive testing. You would also be doing the analytical procedures, for example, why the expenses have been increasing year on year, why the expenses would have increased as compared to last year, what's been the cost driver, which has been leading to the increase of the expenses in the current year as compared to the previous year. Okay. Specifically to the employees, what can be the basis of audit? Some sample testing, when some of the appointment letters of the employees will be picked up, some of the senior management. Then an average cost can be computed in terms of the employee compensation, and that can be compared with the previous year, and it can be checked as to how this has changed and why this has changed. If there are a number of employees who have left during the year, whether there have been new employees who have joined during the year, and that to at higher cost or the lower cost, which will then again become the basis of analysis of the employee cost which is attached to that. Correct? Yeah. So all of these factors are very important on the part of the auditor in terms of testing of expenses. Then there could be certain other expenses which may be tested. For example, depreciation. For depreciation, what would the auditor do? Depreciation calculation will be rechecked. Fixed asset register of the company would be obtained to ensure that depreciation has been computed on all the assets, and the depreciation has not been computed on the assets which are fully depreciated. Correct? Interest, dividend, rent, if any of these are getting paid, whether those are in line with the terms of the agreement. For interest, there could be certain borrowings. So whether the interest is getting furnished on time as per the borrowings contract or not. And if there are any penalties towards that, those are getting recorded in case there have been any defaults, etc. In terms of rent, whether the rent is getting recorded as per the requirements of the accounting standard or not. Whether the adequate provision has been made for the rent, even if the payment of the rent has been made or not. Legal and professional charges. Now, this could be a very important component in the financial statements of insurance company. And anyways, this is considered to be a very important component in the financial statements of any company. Because this not only reflects the right amount of expenditure which is put towards various professionals which would have been hired by the management, or various legal consultants which would have been hired by the management, but from this legal and professional charge, or from this statement of legal and professional expenses, another thing which is drawn, that happens to be the list of the legal cases, an understanding of the litigations which may be going around, and some of these settlements which might have been taking place, and which is a very, very important component in case of an insurance. The nature of its business is such that the involvement of legal and professionals is significant over there. And that's where the importance of audit of this type of expenditure increases significantly. All right. Yeah. Clear on this? Now, as around all of these items which we have discussed, those were focused towards the life insurance companies. Now, when we move on to the general insurance company, if we look at some of their line items, okay, in terms of the audit, so let's see whether those would change significantly. There again, we see premiums. There again, we see claims. And these two are the most important component in the P&L. Yes or no? These two are the most important part of their financial statements. Why? Because once again, for the general insurance company, what's their revenue? Their revenue is nothing but the premium which they get. And what's their expenditure? What's their direct cost? What's their significant expenditure? It's the claim. Claim is a very, very significant component for them. And there again, it becomes very, very significant and very, very important on the part of the auditor. Now, for the purposes of the preparation of the financial statements of a general insurance company, even though we have been following a different schedule, but still some of the requirements in relation to the preparation of the financial statements you'll see are similar. We can see premium over there. Yeah, we can see acquisition costs. We can see claims over there. We can see that actuarial valuation is required over here also. We can also see some sort of investments which are sitting in case of these companies also, and which are required to be valued. Correct? Loans. These companies are also required to give disclosures, and those disclosures are extensive. Those disclosures are again extensive. What are those disclosure requirements? Contingent liabilities, encumbrances to the assets, claims, commitments which are made for loans, etc., premiums which are for the businesses inside or outside India, and that is netted off the reinsurance, aging of the claims, actuarial assumptions, and a whole lot of these disclosures which we understood in case of life insurance basis. So I'm not saying that all of these disclosures are same, but we can see a lot of similarities in terms of the requirements related to the preparation of the financial statements of life insurance company as well as general insurance company. Now, accounting policies, those are integral to the financial statements of any company. So if you are now talking about general insurance company, for them also accounting policies become important. Yeah. So there is some additional information which is required to be disclosed, the way it was required to be done in case of life insurance companies. That was about investments. That was about segregation of performing, non-performing investments. That was about information of financial statements of last years. That was about certain accounting ratios. So all of these things will become important over here also. Then we discussed over there that management report was required to be attached, wherein a specific responsibility was placed on the management. Same way, we have a management report to be captured over here, wherein once again we can see responsibility has been placed on them. Yeah, and all of these aspects are quite similar to what we have discussed in case of life insurance companies. Okay, so I can see a couple of queries. I think I missed one query of Sumit. Sumit is saying, sir, can we write reference to every essay which is applicable? Of course, yes. If you are confident that this is the essay which is relevant, then of course you can give the reference. Mahesh is asking, sir, what is this linked or non-linked policy holder funds? See, the linked or non-linked means depending on the terms of the policy that you get, certain policies will require you to invest your funds. Means I'm talking it from the perspective of insurance company. So insurance company will make the investments. This is what the policy terms requires. Yeah. So those are sometimes linked and non-linked. So that varies according to the policies which are in place. All right. Yeah. Now we are still left with some part around audit procedures on components of the financial statements of general insurance companies and some contents of the auditor's report. Most of the audit procedures would be same. So I would also suggest you can just flip through some of the points related to the audit procedures. Anyways, we'll have a discussion on that in our next session, and we'll also wrap it up in our next session with the coverage around the auditor's report and this requirement related to C also, and we'll also be starting with a new chapter. Okay, so with this we can end our discussion over here. Thanks to all of you once again, and please make sure that before we meet next, you read this so that we can have a detailed discussion on this aspect with the help of certain examples, and we move on to the next chapter. Thanks so much.